wondered, like, if you should be investing or trading in the stock market.
Hmm.
You know,
Yeah.
those terms get thrown around so much.
Right.
But, like, what's the actual difference?
Yeah.
And which one's right for you?
Right.
Today, we're going to do a deep dive into a Bankrate article
Okay.
that breaks down investing versus trading.
Okay.
We'll try to tease out, like, the key differences, explore the pros and cons
Yeah.
of each approach.
Mm-hmm.
And hopefully by the end,
Yeah.
you'll have a better sense of which strategy
Right.
might fit better with your financial goals
Yeah.
and your personality.
Yeah, for sure.
And get this,
Okay.
we'll touch upon a fascinating statistic from the article
Okay.
that shows how time in the market
Mm-hmm.
can often beat timing the market.
That's a really important point, especially when you consider that a lot of people are drawn to the idea of trading because they think they can beat the market, by predicting the right moments to buy and sell.
Right.
But the research really shows that it's incredibly difficult to do consistently,
Right.
even for like the professionals.
Yeah, that's one of the things that stood out to me from the article, too.
Yeah.
I always thought of trading as something that, like,
Mm-hmm.
only Wall Street hotshots did.
Right.
But the reality is that anyone can do it now
Right.
with a few clicks on their phone.
Yep, totally.
But that doesn't mean it's any easier to actually make money doing it.
Exactly. And in fact, it might even be harder for like individual investors.
Oh, really?
Because they often lack the resources, the information, and the emotional discipline
Right. Yeah.
that professional traders have.
Right.
But before we get too deep into the downsides of trading,
Okay.
let's start by really breaking down like the core difference.
Yeah, let's unpack this.
Yeah.
So the article kicks off by emphasizing that.
Okay.
It all comes down to your time horizon
Mm-hmm.
and your mindset.
Yeah.
When you invest, you're thinking long term.
Right.
Like, you're becoming a part owner of that company.
Right.
You're interested in its performance over time
Mm-hmm.
and not so worried about the daily ups and downs of the stock price.
Right. And that's where the analogy of the homeowner versus the house flipper comes in.
Okay.
Investors are like homeowners.
Right.
They're patient.
Mm-hmm.
They're in it for the long haul.
Yeah.
And they understand that property values tend to appreciate over time.
Right.
Traders, on the other hand,
Yeah.
are like those house flippers
Okay.
who are always looking for a quick profit,
Right.
buying low and selling high,
Mm-hmm.
often within a very short time frame.
Okay, I love that analogy.
Yeah.
It really helps to visualize the difference.
Yeah.
So if investors are all about that steady long-term growth,
Mm-hmm.
what about the traders?
Yeah.
What are they looking to achieve?
Well, with traders, it's all about trying to capitalize on market swings in the short term.
Okay.
They're not necessarily interested in the underlying business itself, but rather how they can predict and profit from price movements.
Oh.
So instead of focusing on things like
Yeah.
a company's earnings
Okay.
or its management team,
Right.
traders tend to rely heavily on something called technical analysis.
Technical analysis.
Yeah.
Now that sounds a bit intimidating.
Yeah.
Can you break that down for us a little?
Sure. Think of it as looking for patterns and signals in historical price data.
Okay.
They use charts,
Yeah.
indicators,
Yeah.
all sorts of tools to try and predict where the price of a stock might be headed next.
Uh-huh.
So instead of poring over financial statements like an investor might,
Yeah.
a trader is more likely to be glued to their computer screen,
Right.
looking at these squiggly lines and charts.
So it's a lot more about reading the tea leaves of the market,
Yeah,
so to speak,
precisely.
than digging into the fundamentals of a company.
Yeah, and because trading is so focused on short-term price movements, it often involves a lot more buying and selling activity than you would see with investing.
Right.
Some traders might hold a stock for just a few hours,
Oh, wow.
minutes, or even seconds,
Wow.
trying to make a quick profit on tiny price fluctuations.
Wow. So there are traders out there who are making decisions in seconds.
Yeah.
That sounds incredibly stressful.
It definitely can be, and that's one of the key differences between investing and trading,
Okay.
the level of time commitment and emotional energy required.
The article briefly touches on some different types of traders,
Mm-hmm.
day traders,
Yeah.
swing traders, scalpers.
Mm-hmm.
Can you give us a quick rundown of what each of those actually means?
Absolutely. So day traders,
Okay.
as you might guess from the name, buy and sell stocks within the same day,
Okay.
sometimes making dozens of trades in a single session.
Wow.
They're trying to capitalize on those tiny price fluctuations throughout the day.
Okay.
Then you have swing traders who hold stocks for a bit longer, usually anywhere from a few days to a few weeks, looking to ride those short-term price swings.
Gotcha. And what about those scalpers?
Yeah.
They sound kind of intense.
Yeah, scalpers are like the extreme athletes of trading.
Wow.
They hold stocks for incredibly short periods,
Jeez.
sometimes just a few seconds,
Oh.
trying to profit from minuscule price changes.
Okay.
They need lightning-fast reflexes
Right.
and a high tolerance for risk, because even a tiny miscalculation can lead to a big loss.
Okay, so it seems like with all these different types of traders,
Mm.
the common thread is that
Yeah.
they're all actively trying to time the market in one way or another.
Right.
But is it really possible to consistently predict where the market is going?
That's the million-dollar question, right?
Yeah.
And the Bankrate article dives into some research that suggests it's probably not as easy as it sounds.
Okay.
For example, it highlights a study by S&P 500 Dow Jones Indices
Okay.
that found over 90% of professional fund managers,
Wow.
people who do this for a living,
Right.
actually failed to beat the market over long periods.
Wow. If the experts are struggling to outperform the market consistently, that's a pretty sobering thought for anyone considering jumping into trading.
It is, and it leads into a really important concept that the article emphasizes:
Okay.
passive investing.
Okay.
The idea is that instead of trying to outsmart the market,
Right.
you're better off just investing in a broad market index fund
Mhm.
that tracks the overall performance of the stock market.
Okay.
It's essentially like saying, hey, I'm not going to try and pick individual winners and losers.
Right.
I'm just going to bet on the market as a whole going up over time.
So you're kind of admitting that you can't predict the future,
Yeah,
but you're still confident that the market will generally trend upwards over the long term.
exactly. And there's a lot of historical data to support that belief.
Sure.
You know, the stock market has always gone through ups and downs,
Right.
but over the long term, it has consistently trended upwards.
So it's like that saying, it's not about timing the market.
Right.
It's about time in the market.
Yeah, that's a great way to put it. And speaking of timing, the article also dives into some of the hidden costs of trading,
Okay.
things that might not be immediately obvious,
Right.
but can really eat into your profits over time.
That's what I found really interesting.
Yeah.
The article doesn't just sing the praises of investing.
Right.
It also shines a light on the potential downsides of trading.
Mm-hmm.
For example, it mentions the concept of trading being a zero-sum game.
That's right. For every trade that someone wins,
Right.
there has to be someone on the other side of that trade who loses.
Right.
In a way, it's kind of like gambling.
Okay.
Investors, on the other hand, can all potentially benefit from the growth of successful businesses.
Right.
They're not trying to outsmart each other.
Right.
They're all participating in the overall growth of the market.
So with investing, it's less about beating someone else
Yeah,
and more about everyone riding the wave of economic growth together.
exactly. And there's another hidden cost of trading that the article points out, something that really resonated with me.
Yeah. And it was a bit of a mind-blowing stat when I read it.
Yeah.
It said that missing just the 10 best days each decade could drastically reduce your overall returns.
That's right. And it gets to the heart of why trying to time the market can be so tricky.
Right.
If you're constantly trying to avoid dips and pull your money out,
Right.
you might miss the rebound that follows.
Yeah.
And over the long term, those missed opportunities can really add up.
So even if you're right, most of the time, missing out on those big gains can really hurt you in the long run.
Exactly. It reinforces the idea that time in the market is often more important than trying to time the market.
And on top of that, the article mentions that frequent trading can also lead to a pretty hefty tax bill.
Absolutely. Every time you sell an investment for a profit,
Right.
you trigger a taxable event.
Right.
So traders who are constantly buying and selling end up paying more in taxes,
Right.
which eats into their returns.
Whereas investors who buy and hold benefit from tax-deferred growth. It's like a sneaky bonus for being patient.
Exactly. And speaking of patience, the article mentions Warren Buffett's investing philosophy as a prime example of the long-term approach.
Right. Good old Warren Buffett.
Yeah.
He's a big advocate for consistently buying index funds
Mm-hmm.
and holding them for decades.
Yep.
He believes in the power of compounding
Right.
and letting the market do its work over time.
And his track record certainly speaks for itself. But before we wrap up this part of our deep dive,
Okay.
I think it's important to acknowledge that while the article leans heavily towards investing as the winning strategy for most people,
Okay.
there are situations where trading might be suitable.
Okay. So it's not a black and white issue.
Yeah,
There's some shades of gray here.
absolutely. For example, individuals who have a very high risk tolerance,
Okay.
a deep understanding of markets, and the time and resources to dedicate to active trading might find it a suitable approach.
Right.
But for the average person, the long-term buy and hold strategy of investing is likely to be a much more prudent path to building wealth.
So it sounds like when it comes to choosing between investing and trading,
Yeah.
there's no one-size-fits-all answer.
Right.
It really depends on, like,
Yeah,
your individual circumstances,
for sure.
your risk tolerance,
Hmm.
and how much time and energy you're willing to put in.
Exactly. And while the Bankrate article does a great job of highlighting
Yeah.
the benefits of investing
Uh-huh.
and the potential pitfalls of trading,
Right.
there's one crucial aspect that it doesn't really delve into, the
Okay.
psychology of investing.
Oh, yeah, that's a really good point.
Yeah.
I mean, we've talked about the financial side of things,
Yeah.
but what about the emotional side?
Right.
How do our own personalities and biases
Yeah.
play into all of this?
Well, think about it.
Yeah.
Trading with its constant ups and downs can be an emotional roller coaster.
Yeah.
You're constantly checking prices, making decisions on the fly,
Yeah.
and dealing with the fear of missing out or the regret of making a bad trade. It takes a certain temperament to handle that kind of pressure
Yeah.
without making impulsive decisions based on like fear or greed.
So it's not just about having the knowledge and the skill.
Yeah.
It's also about having the right mindset
Right.
to stay disciplined
Right.
and not let your emotions get the better of you.
Exactly. Whereas investing with its long-term perspective
Yeah.
tends to be a bit less emotionally charged.
Okay.
It's more about having the patience and the discipline to stick to your plan,
Right.
even when the market gets bumpy.
So before you even think about diving into the stock market,
Right.
whether it's investing or trading,
Yeah.
it's worth taking a moment to reflect
Mm-hmm.
on your own personality
Mm-hmm.
and how you typically react to risk and uncertainty.
Yeah.
Are you the type of person who can ride out the storms
Right.
and stay calm under pressure?
Mm-hmm.
Or do you tend to get anxious
Yeah.
and make impulsive decisions when things get volatile?
That's a great point. Knowing yourself and your own emotional triggers is just as important as understanding the mechanics of the market.
Yeah.
And if you're honest with yourself
Yeah.
and realize that you're not cut out for the high-pressure world of trading,
Yeah.
that's okay.
Totally.
There's no shame in sticking to a more passive,
Right.
long-term investing approach.
Yeah.
That aligns better with your personality.
So it's all about finding a strategy
Right.
that you're comfortable with
Yeah,
and that you can stick to over time.
for sure.
Because ultimately, consistency is key
Yeah,
when it comes to building wealth in the stock market.
absolutely. And that brings us back to that crucial statistic that we mentioned earlier, the one about missing the best trading days.
Yeah.
It's not just some random piece of data.
Right.
It actually highlights a really important psychological phenomenon
Yeah.
that often trips up investors.
Right. It's not just about bad luck or missing out on a few good days.
Yeah,
It's often driven by our own behavioral biases.
exactly. You know, when the market takes a dip, it's natural to feel fear
Yeah.
and want to pull your money out to avoid further losses.
Right.
But that's often when the best buying opportunities arise.
Yeah.
And on the flip side, when the market is soaring, it's tempting to jump in
Right.
and try to ride the wave.
Yeah.
But that's often when the risk of a correction is highest.
So it's like our emotions are constantly trying to sabotage our long-term financial goals.
Yeah.
We get greedy when we should be cautious
Right.
and fearful when we should be greedy.
That's a great way to put it. And that's why having a clear investment plan
Yeah.
and sticking to it
Right.
is so crucial.
Mm-hmm.
It helps you to take the emotion out of your decisions
Right.
and stay focused on your long-term objectives.
So it's not just about picking the right stocks or
Yeah.
timing the market perfectly. It's also about having the mental discipline to stay the course
Right.
and not let your emotions lead you astray.
Exactly. And one of the best ways to do that is through something called dollar cost averaging.
Dollar cost averaging. Now, that's a term I haven't heard before.
Yeah,
Can you break that down for us?
sure. It's actually a pretty simple concept.
Okay.
Instead of trying to time the market
Right.
and invest a lump sum all at once,
Yeah.
you spread your investments out over time,
Okay.
investing a fixed amount at regular intervals,
Right.
regardless of what the market is doing.
So even if the market is down, you're still buying in at that predetermined time.
Exactly. And the beauty of this approach is that it takes the emotion out of the equation.
Right.
You're not trying to guess when the market is going to hit bottom or when it's going to peak.
Gotcha.
You're just consistently investing over time,
Okay.
which helps to smooth out the ups and downs
Right.
and potentially lower your average cost per share.
So it's kind of like saying, hey, market, do what you got to do.
Right.
I'm just going to keep plugging away at my investment plan.
Exactly. And the Bankrate article doesn't really dive into this, but I think it's an important point to make, especially for people who are new to investing. You don't have to be a Wall Street whiz or a day trading guru to be successful in the stock market.
It's more about having a solid plan, being consistent, and not letting your emotions get in the way of your long-term goals.
Absolutely. And remember, investing and trading are just tools. And like any tool, they can be used effectively or ineffectively. It's all about understanding how they work. Knowing your own strengths and weaknesses and choosing the right tool for the job.
That's a great analogy.
Yeah.
So as we wrap up this deep dive,
Okay,
what's the key takeaway that you want our listeners to walk away with?
I think the most important thing is to understand that there's no right or wrong answer when it comes to choosing between investing and trading.
Okay.
It's all about finding an approach that aligns with your individual goals, risk tolerance, and personality. Do your research, ask questions, and most importantly, be honest with yourself about what you're comfortable with.
And remember, there's no shame in seeking out professional advice.
Yeah, absolutely.
If you need help navigating the world of investing and trading.
A financial advisor can help you to develop a personalized plan that takes into account your unique circumstances and goals.
So we've covered a lot of ground today.
Yeah, we have.
From the core differences between investing and trading to the hidden costs, the importance of understanding your own psychology, and how to avoid some of those common behavioral traps that can trip up investors.
It's been a fascinating deep dive.
It really has.
And I hope our listeners have found it valuable.
I think this deep dive is giving our listeners a lot to think about,
Yeah.
When it comes to figuring out their own approach to the stock market.
For sure.
Are they more of an investor or a trader at heart?
Right. And it's not something you have to figure out overnight. I mean, it's a journey, right?
Yeah.
Learning about these different approaches, experimenting maybe a little bit, and figuring out what feels right for you.
Exactly. And speaking of experimenting, the article doesn't really touch on this.
Okay.
But I think it's worth mentioning that there are ways to, dip your toes into the world of trading without necessarily going all in.
Yeah.
You can start small.
Yeah.
Maybe with a practice account.
Right.
Or with a limited amount of money that you're comfortable potentially losing.
That's a really good point.
Yeah.
Kind of like a test drive before you commit to buying the car.
Right.
You can get a feel for the process, see if you enjoy it.
Yeah.
And if it actually aligns with your personality and risk tolerance.
Right. Because I imagine for some people, the excitement and the challenge of trying to beat the market might be really appealing.
For sure.
But for others, that same level of pressure and uncertainty might be absolutely terrifying.
Exactly. And there's no right or wrong answer here.
Right.
It's all about finding what works best for you.
Right.
And what helps you to sleep well at night.
And speaking of sleep, I know I've definitely stressed about money and investments before.
Yeah.
Especially when the market is going through a rough patch.
Right.
Have you ever found yourself losing sleep over your investments?
Oh, absolutely. I mean, it's natural to feel a little bit anxious when you see your portfolio dipping. But I think that's where having a long-term perspective really helps. Reminding yourself that the market always goes through cycles. And that short-term fluctuations are normal.
Right. It's like that saying, don't worry about the waves, focus on the tide.
Exactly. And that's why I always come back to the importance of having a solid investment plan, one that you can stick to. Even when the market gets chalky, it gives you a framework to make decisions. It helps to remove the emotion, and it ultimately allows you to sleep better at night, knowing that you're on track to reach your long-term financial goals.
I think that's a great note to end on.
Yeah.
Finding that balance between being informed and being prepared, but also not letting the stress of the market consume you.
Absolutely. Investing should be a tool that helps you to achieve your goals.
Right.
Not something that keeps you up at night.
Well said. So, to recap, we started this deep dive by exploring the Bankrate article, which really helped us unpack the core differences between investing and trading, the pros and cons of each approach, and ultimately which strategy might be a better fit for different types of people.
Right, and we went beyond the article too, talking about things like the psychology of investing, the importance of understanding your own risk tolerance, and how to manage those inevitable emotional ups and downs that come with being in the market.
We also touched on some practical tips.
Yep.
Like dollar cost averaging and the idea of starting small.
Yeah.
And experimenting to see what feels right for you.
I think this deep dive has given our listeners a lot to think about.
Yeah.
And hopefully it's equipped them with the knowledge and the confidence to make informed decisions about their own financial future.
Absolutely.
Yeah.
So remember, whether you choose to invest, trade, or maybe a little bit of both,
yeah,
the most important thing is to do your research.
Right.
Be consistent.
Yep.
And stay focused on your long-term goals.
And don't be afraid to seek out professional advice if you need it.
Well, that wraps up another fascinating deep dive.
It does.
Until next time, happy investing, everyone.